Well, hello everyone. Welcome to Trading Index Options. My name is Barbara Armstrong. I am a coach and a senior manager with Schwab, and you are not getting the dulcet tones and experience of Mr. Ben Watson today. I am filling in his stead. He has been doing a lot of traveling, and so he's spending a couple of well-deserved days with his family. And so I'm going to talk trading index options with you. I love the humor in this group. So someone typed into the chat and said, Ben usually trades European style options. Am I going to trade Canadian style options? And well, I would like to digress from the plan. I've actually signed into Ben's account today, and we are going to go with the Ben flow. So not quite sure what a Canadian index option would look like. Actually, I do know a few, but yeah, be that as it may, I've got Mr. Brent Moores in the chat with us today. He's a friend and a fellow coach, and he understands this stuff inside and out. So if you've got any questions, don't hesitate to type them into the chat. Brent is also posting a lot of great content on X. You're going to want to follow both him and I there. Brent Moore CS and Barb Armstrong CS. One of the things I do post also is when I'm filling in for someone. So I posted today that I was filling in for this class and then for Scott Thompson in the next class, getting started with stock investing. And then I'm going to fill in for Connie tomorrow for long verticals. So, and that I'm going to partner up with our trading a smaller account class. So there's lots of news you can use on X. So if you're not there, be square. It's easy to set up an account. If you can't figure it out, you can ask your kids. Um, and if you're a kid, well, you won't be intimidated. That won't be the issue. Okay, so keep in mind as we look at these index options that everything today is for informational purposes only, none of it to be construed as a recommendation on the part of Schwab or myself. That all investing involves risk, including the loss of principal. We are using index options here and know that equity and index options carry a high level of risk and aren't suitable for all investors. With American style options, those can be assigned at any time prior to expiration, regardless of how far they are in the money. Now, one of the differences between paper money and a live account is that short options are never assigned early in paper money. However, we're not doing American style options. We're doing European style options, which are only, cash settled at expiration. So that isn't, as big a deal. Keep in mind that if we use a stop loss order, a stop market order, it's no different than using a stop order on a stock. There's no guarantee that it will be filled. Okay. Okay. So that's my little overview. Now let's get right out to the platform. And I really love this idea. One, I am a big kiss person. I am a hugger kind of person, but I like things to be simple because if it's simple, I will do it. So I am a big fan of the KISS principle, the keep it simple, silly, or whatever other word you want to use. And so the idea that Ben has been talking about ad nauseum, for a long time, is this idea of we're going to look at the SPX on a weekly basis. And what are we going to do? We're going to do the same thing every week. And so we are going to go out and we are going to do a vertical trade, either a short put vertical. So if the SPX is trading above this 200-day moving average, we are going to do a short put vertical with 14 days to expiration. And if it's above this line, we're doing a short put vertical. If it's trading below this line, we're doing a short call vertical. And we don't have to wiffle waffle, like that's the plan. Okay, so we put the trade on, and then 1 week later, when it's 7 days to expiration, no matter what is happening, so we don't have to have a conversation with the Divine Trilogy, the Divine Trilogy being me, myself, and I. We don't have to have a conversation. It's like, ooh, which you can be tempted to do. And when we look at the trade that we're closing out today, so here we're opening the trade, And then here, we're going to close the trade. So that is the trading plan. Pretty simple, right? And you may say, well, why do we do it on Wednesdays? Well, because the class meets on Wednesdays. You know, that's why we do it on Wednesdays. Now, could you do it more than one day a week? You could. You could do it on Mondays, Wednesdays, and Fridays. But you have to keep in mind that, you know, you're adding more risk if you have 3 trades on at a time. You know, and then you've got to know that you're going in and you're going to, you know, you're going to have to manage then those trades 3 days a week. It just depends on your account size, how much risk you're willing to take on any one position at any one time. You know, but we do it Wednesdays really because we meet on Wednesdays. Okay, so that's the plan, just in case we have somebody new. And if we have someone that is new to this class for the first time, and I see a lot of who I affectionately call the usual suspects. So hello to Jay and Sia and Riceberg and Laura and Kelly and Will and Sharon and the rest of the gang. It's so good to see you all here. And I see you all in, you know, the regular classes I teach as well. And it starts to feel like family. So I'm glad that a lot of you have come to live events and I've had the chance to meet you. And let's go in and do a little trade management, and then let's look at live events and where you might have the opportunity to not only meet Ben and myself and some of the other instructors, but to meet each other. Like I've met people when I was a client that became friends that you know, I'm in touch with to this day. So it can be kind of a cool thing. So last week we did a short put vertical. Why? Because the S&P, the SPX index was trading above, okay? It was trading above the 200-day moving average. And if you're wondering, if you don't have a 200-day moving average and you're saying to yourself, how do I add that? You're just going to come to studies, edit studies, and I have only 2 things on here: a simple moving average that's 200-day, and you can just start by typing in simple moving average. And we do have some newbies here today, so welcome. And then you just hit add selected. Now the default is typically 9 days. I don't know why this is showing as 50, but we just want the 200-day moving average. So I'm going to delete that. But if you want to edit that, you can come in, make it 200, and then make it wider. So Ben has set his defaults because typically the default is 1. So we're going to delete that. And then the other thing that is on here is probability of expiring. This cone. Now, the only cones that I have been familiar with involve 1, ice cream, and 2, a dog coming home from the vet, where you want, you know, him or her not to be able to touch various body parts. And so I have both affectionate and kind of non-affectionate, you know, relationships with cones, so to speak, because I always hated having to do that to a pet, but I loved ice cream cones. And so we have this cone of probability, and you can see we have this line here that says, okay, here's our probability that we're aiming for. But if you find the cone of probability confusing, you don't have to use it. You could just say, I'm going to pick a delta in the 14 to 17 point range. Okay. And so how would we do that? Well, if you come to the trade tab, and Ben will be delighted to know that I set up I customized something. I called it Barb's Basics. So that's now in his thing. But what I put in here, we've got bid and ask. Those are the defaults. Delta, and then probability of something being in the money, and probability of it touching. And so if we come out and we do a short put vertical, and we're looking and for, let's say, a 15 delta, that would be right here. And one of the columns, oh, I thought I put that column on. So let's adjust it. I guess I didn't save it. So I'm going to come to my Barb's Basics over here, and we are going to customize that. And I'm going to add, I'm going to add volume. Okay, where's my volume? Okay, I'm having a brain fart. What's the one that I want for open interest? Oh, why is that not showing up? Open interest. Huh. Okay, so let's come into okay. Oops. Customize. Column set. Open interest. There we go. Open interest. Well, I want open interest and volume. And so open interest is number of contracts that were on the books when the market opened today. Volume is number of contracts. And we're going to put this, we're going to save that as a new one. Yeah. Okay, so now we've got open interest. And the reason I want this column up here is because if we look at this delta of 15, around this 68.60 mark, we've got a $21 option and we have a 30-cent bid-ask spread. So the bid-ask spread is tight, and we've got 25 contracts traded today, 50 on the books at, when the market opened today. And this tight bid-ask spread means we've got some liquidity if we want to get in or out. And so what Ben has been doing in this account is once a week, we come in and we sell it, and we're doing a vertical. And this is the default is the smallest width. We're doing $20 wide. So we're going to do $20 wide. So we're doing 68.40. And we're getting a $2 credit. So that means the most we can make is $2, and we're risking $1,800. And you may say, gee, that's not a really great risk return ratio. If I take 2 divided by 18, it's 11%. And so if we were doing, in our trading a smaller account, we'd want a higher rate of return than that, but we're not typically trading a 15 delta. And what a 15 delta means is if the SPX goes up by $1, we can expect the value of this option to drop by 15 cents. What the probability in the money column that I brought in means, it means that you've got a 16% chance in 14 days of this being in the money. But you have a 32% chance with this probability of touching, of it coming in, at least giving it a kiss and being in the money at least momentarily. Okay. And that's not unusual. And so if it comes down, are we going to be, in panic mode? No. What are we going to do? We're going to follow our plan, right? And the plan is we wait for a week and then we exit the position. And so if we can get 205 for this, we're going to come to confirm and send. And then we are going to put this, well, you know what? We're going to put this in a group. I'll move it to that group afterwards. But, and we want to read these notes. So we're selling a vertical. It's a short put vertical with a $20 wide spread. The most we can make on this is $205. The most we can lose, $1,795. Okay, so somebody's saying, wouldn't it be better to look at the May 22nd expiry? We get more money for it if we looked at that, but our plan is we're choosing an expiration date 14 days out. And then next week, we're going to close this trade. Okay, and we're going to open a new trade. All right. So we're selling this vertical. We have defined risk, our max loss, we have defined gain. And we want to read this. This is saying this was accepted without sufficient trades. I'm not sure why that's rejecting. Let's go in and look at how much he's got in this account. On the trade. Let's come to. Oh, this account has 0 in it. That's why I'm in the wrong account. This one has 13 million. He goes from being a no roller to a high roller. Okay, so let's just do that again. So we're going to come in, we're looking at the 68.60. We're going to sell a vertical. We're going to make it $20 wide. So we're going to 68.40 and all the same things apply. I don't know why this is giving me illegal shares. We've got 13 million. We've got 2 million in cash and sweep. So we should be good to go. Let me just total. Okay. Third time's the charm. Okay, so we got a fill on that. Now let's come and look at the trade that was placed last week. So last week in our weekly index option trade, we did a short put vertical. Why a short put vertical instead of a short call vertical? Because it was trading, the SPX was trading above the 200-day moving average. And we made 220 on that. It's now worth 55 cents. So if you're looking at that and saying, well, it's still looking pretty good. Like, why don't we just like let it expire worthless? We could make another 60 cents. Well, if we get our calculator and we say, but we've got 55 cents left. So, and we were paid 220 to get in. So we've got 75% of our max gain. And if we leave this trade on and we place a new trade, now we have double the exposure. And so what we're going to do, and I double check this before we place this trade because, and I sorted by symbol, I went through to make sure that Ben hadn't put in an exit at 80% of max gain or something like that. But there are no exits in place for an SPX position. So now I'm just going to right click. Sorry, don't know why view came up. We're going to right click, create a closing order to buy back this vertical for 55 cents. So, for those of you who are baseball fans, is this a home run strategy? It is not. This is a base hit. It's just like, just get on base. And if we can do this month after week, month after month, it starts to look like, smell like, feel like real money, right? So that's the idea. This is a base hit strategy. So, and somebody has typed into the chat, see, that's a 70%, 5% return on investment in a heartbeat. Well, it's quite a few heartbeats because it's a week's worth of heartbeats, but it's a week's worth of heartbeats. So we've got that position now that we've closed out. We've taken our unrealized gain and turned it into a realized gain. And now in our, we've got a lot in unallocated, but we also have this position here, which we just put on. And now that that's filled, we want it to go, we want to move it to this group so that Ben can find it easily, index options weekly. Okay, so full disclosure. One, when we look at this probability cone, I went and chose the strike based on, based on probability. But if we look at this probability cone where it's marked, it's right around that 80, 68. This is such an expensive index, around that 68, 70 mark. And where were our strikes on this? So if we come back up to, I'll close that again. Close this. So now we have one trade, 68.60. So, we were pretty darn close, right? Right. So why don't we do this? Like, because it just sounds kind of delicious, even though when it goes wrong, like it can wipe out, 7, 8, 9 trades, profitable trades. If you have one that goes wrong, you can wipe out quite a few, right? But why not look at doing this on the NASDAQ as well? Because, if we look at the NASDAQ, it's trading above the 200-day moving average. And couldn't we come and look at the trade tab and look out 14 days and say, let's look at something, with that similar delta around this 15 mark, but we're seeing the bid-ask spread is a little wider, right? Not, it's certainly well under 10%, so not too shabby. But here's the bigger concern. How many contracts? 2. How many traded today? 0. So what does that mean? It means it's going to be you and the market maker. Now, I'm not saying the rumors that market makers, have been known to eat their own young are true, but might they have a little more experience than us? They have more experience than me, I'm fairly confident, most of them. And so I want to try and run with a crowd, no matter what strategy I'm trading. And so even if you looked at this and went, yeah, but, well, there's no yeah, buts. Like if that's one of your guidelines that you want there to be, at least 20 times the number of contracts, the other thing is, what's the minimum bid-ask spread here? It's $50. So how much are we risking to do this trade on the NASDAQ? We're risking over 4 grand. So our minimum amount of risk is going to be double what it is on the SPX. And I was thinking as I was getting ready for this, like, ooh, maybe we should do this in our trading a smaller account. But we can't risk $1,800 on a trade. Like that's our snack bracket says max risk is $500. And so, we could do, a narrower strike zone on, and we would have the option to do that on the SPX, but we don't on this. And here, if we went from, some of these, like it's $100 wide, not 50, this is 50. If it was $100 wide, you're risking, more. And so NASDAQ, yeah, no. How about the RUT? Small caps and, the RUT, when we look at how many stocks are part of it, it would give us a lot of diversification. Again, if we come out and we look in this neighborhood of the 15 delta, is the bid-ask spread okay? Yeah, not too bad. But if we come here and look at this, how many contracts were on the books when the market opened today? That would be 0. How many on the books here? How many traded today? 5. Is that 20? No. Yeah, somebody's asking about another ticker. That's an ETF. We talk about ETFs. Rachel Deshelle does a class on Mondays, and then James Boyd and Kevin Horner talk about ETFs in Trader Talks on Fridays. So we don't talk about that in this class. So when we look at this index, and you might say, well, what about the 2630? That's a delta of 15, but we have to have something on the other side of it. And so with this one, with the RUT, actually, we could do a 2630, 2620. So that might be a possibility. And that too is above the 200-day moving average. So, but, when we look at this, and again, if the rule is simply, it's binary, is it above the 200-day moving average? Then we look at, then we do a short put vertical. If you're trading this, trade in this way. Let me just activate this since somebody put a nice little title there. Okay, so if we came here, so the rut is a possibility. So if we look at this 15 and then we did the 2620, if your criteria is it's got to be 20 contracts or more, 20 times the number we're thinking of trading, and we want a tight bid-ask spread. So if we look at that 2630 and we sell a vertical, we'd get 60 cents. Now, if we do it $10 wide, and Ben does 20, I don't know if we could do on the SPX. We don't have enough volume here to do 20. So, but if we could get $1.20, and then how much are we risking? Well, we're risking 880, right? So if I look at 120 divided by 880, that's a 13% potential return, 13.6, but who's counting, which is a higher percentage return than the SPX trade. But, and we have transaction fees going in and out. But if we said, okay, this one actually does meet our criteria, 2630, 2620. Yep. So we're going to put this on, and we're going to put this in our index options weekly. Okay. Fire in the hole. Okay. Well, how about the Dow? Could we do something like this on the Dow? So if we look at this above the 200-day moving average, and if we're looking for this delta, now here we don't have the same range. So we can't go 14 days out, because on the Dow, we've got a monthly, we have this one that's expiring in 1 day, that doesn't, the next one is 22 days out. And so this is it would be a totally different strategy. And if we're looking at a delta of about 15, we're a little shy of what we want. And our bid-ask spread, 178 and 244. Like if this is a $2 option, you don't want this to be more than 20 cents. And you could drive a truck through that bid-ask spread. So we don't have the expiration date we want on the Dow. So there's the one strike. We don't have volume, the kind of volume we're looking for, 2 strikes. And the bid-ask spread, yeah, not looking too delicious, like not meeting our criteria. So the spread is too wide. So strike 1, strike 2, strike 3. And really, we don't need 3 strikes and you're out. 1 strike. It's either you have a rule and you follow it, or you don't have the rule. And this isn't breaking 1 rule, it's breaking 3. So are we going to do it? We are not. We're not going to do it. Now, could we use this type of strategy? And we've done this in years past. I remember us doing this on Apple when Apple was really uptrending. We would do a weekly short put vertical on Apple out 21 days. So, the idea, and I'm not saying we want to do it on Apple necessarily. And let me just get rid of our probability cone for this. Oh, and then let's come to time axis. We want to add some bars to the right. So the idea being, if you find a stock and it's just continuing to uptrend and march up the hill nicely, like Ross Stores is one that I was looking at that's kind of been in that boat. So it's just continued to kind of walk up the hill. It's probably using a 30-day moving average as support. So could we come down below, it's trading at 226. And if this were bouncing today, could we come down and look 3 weeks out, so this 23 days, well, and we're not going to need 120 strikes. Let's go back to 10. So could we come out and say, could we sell the 220? We have a 30 delta, and this, we may want to have a different rule set. Say, we want to delta in that 20 to 40 range. We've got 300 contracts, so we're okay. Sell a vertical, we'd get a $1.55 on a 250 wide spread. What if we did a $5 wide spread? So if we did 220, 215, why is that a debit? Oh, we did calls. We wanted puts. That's weird. 220. We're selling a vertical. $2.15. So we get $1.17. And the idea being that you could just do a wash, rinse, repeat. Now, why am I not going to put this on in this class? Well, because we're talking index options and we're talking European style options, and this is neither one. This is a stock. And what's the disadvantage of a stock? The disadvantage of a stock is that when we look at a stock, news can come out on any one company. When we look at something like the Russell, we've got 2,000, the Russell is the smallest of the companies listed in the Russell 3000. So it's the 2,000 of the smallest companies. But you've got 2,000 different companies represented here. And so it's more likely to be a swing due to interest rates or, geopolitical something going on than it is to be news about an individual company. Because if we come and we look at the Market Watch tab and we come to visualize and we look at the Russell 2000, like even the biggest companies, are pretty small. Like as opposed to the Dow 30, where, if NVIDIA, Apple, and Amazon are having a bad day, this whole index is having a bad day. And the same thing with the NASDAQ. Like if the tech sector is having a bad couple of months, as it has had, then this index is not going to do well. And today we've got, a lot of green on the screen. So when we come and we look at the Russell, it hit a new intraday all-time high yesterday. We look at the NASDAQ, it hit a new high. It'll be a new closing high for this index today. And so you would think, like, there's so much talk about these indexes, that why aren't they more heavily traded, or the options on them? So somebody asked to look at this index. Sorry, MGTN colon CGI. So this is the Magnificent 10. And we're hitting a new high on this one today. If we want to see, let's see if we come to analyze, if it will tell us. Oh, I guess I have to link that. It's not giving us details here. It's like the Mag 7, only we've got 10 stocks in here. But again, if we come to our trade tab and we come out and we say, well, we don't have a 14-day expiration option. But even if we look at the monthlies here, and the monthlies tend to be more heavily traded. Looks like Ben has some type of trade on here somewhere. And again, if we're trying to look at a delta, that's part of our plan. So if we look at this 15 delta, we've got a reasonable bid-ask spread, but we've got no volume on these at all. Yeah. We've got no volume on these at all. And so if you're saying, well, the bid ask spread is 40 cents, it's a little more than 10%, but I'm okay with that. It's like, is that really where you want to be? You and the market maker. And there are many that would say nay to that. They're going to go, yeah, just me and the market maker. I don't think so. And then you've got to look at, if I were to sell a vertical here. So that's, close to 90%, right? 12 divided by 88. Well, that's 14%. So, and you can make these wider, but it's you and the market maker. And so this is why there are many that would say, yeah, no, I'm going to stick to doing my weekly routine and I'm going to make trading index options part of it. I like the fact that they're European style, so there's no early assignment. I have a plan. I trade my plan. I'm not double thinking it. Every Wednesday I go in and this is what I do. And the thing with the SPX, when we come back and look at this and look at expiration dates, I mean, 1, 2, 5, 6, 7, 8, 9, 12, 13, 14. These are days to expiration. There's a daily expiration on these, and they're heavily traded. And so it allows for our very specific trading plan to work. Okay. Okay. Now, I want to just show you quickly a couple of things. One is, and I thought I put this in here. Next up is the Chicago Market Drive. And if you have never been to a market drive, I think this is going to be the first one that Ben is missing in many years. He's going to be at a wedding. He tried to figure out how to be in two places at once, but so far with current technology, that's not quite possible. But Kevin Horner and I will be there. Joe Mazzola. We've got people come in from all over the country for these things. We'll have the coffee on in the morning. It's actually in Schaumburg. And we'll provide a lunch, we'll provide a great reception at the end of the day, and we go from here's what's happening geopolitically in the world, here's how tariffs are impacting things and other things going on within our own borders, down to what's happening with sectors, and then down to individual stocks. So it's a jam-packed day. Then we have a 2-day event coming up in San Diego. Before that, actually, there's a 2-day event in Santa Clara. And the Santa Clara events fill up fast. So that's not on this schedule. If you live in that area, you can show up and we'll find you a spot where you can register on site. But you're better to know, and we're better to know that you're coming. And so I encourage you, if you live in the San Diego area and you're planning on coming, this is a 2-day event. First day, getting started with technical analysis. Second day, options. And then the same thing in Chicago in July, back at the Renaissance in Schaumburg. These are free to attend. So I encourage you to, to take advantage of this if you can. Next week also, so if you come to this schwab.com/actually coaching. So schwab.com/coaching. So next week, if you come to live webcasts and virtual workshops, you will see that you have the option to check or uncheck webcast. So if I uncheck webcast, you'll see that next week, starting at 5 Eastern, there's a technical analysis virtual workshop. It runs an hour and a half from 5 to 6:30, Monday through Thursday. So it's another way for you to get, just a lot of great educational content, without having to leave your home. And so that's coming up next week. You can register for that. We have thousands of people attend those when they are offered. Okay. And then, if you're saying, like, I really love Ben and his style, I'd like to see the webcast that he teaches. You can come here to coaches and say, when is Ben teaching? And you'll see the classes that he typically teaches. And you'll also see, like, he filled in a couple of weeks for Cameron May, who was out of the office. These are his regular classes, trading futures and trading index options. Okay, the other thing you're going to want to do is subscribe to the channel. So if you come to the Trader Talks channel on YouTube, and I come here a lot, I'm a frequent flyer. So what comes up, when you first log in is whatever's currently being taught. And then if you click on playlists, if you'd like to do a bit of binge learning, you can just scroll down and look for the trading index options class. And then, this will be reviewed and then available in the archives, typically by the end of the day. Okay. Okay, so guys, that's what I had for you today. If you'd hit the like button, it helps move things up in the trading algorithm so that more people can find this content. Don't forget to follow Brent Moores and I in the Land of X, Brent Moores CS and Barb Armstrong CS. Hit the like button, subscribe, consider attending a live event. And next week, you will be back to the dulcet tones of Mr. Ben Watson. I appreciate you hanging with me today. Thanks for being here and for being so participatory in the chat. If you're brand new, keep coming back. Up next will be me again, filling in for Mr. Scott Thompson. So stay tuned. Lots more great content coming your way. Bye for now.